and in this lecture we will understand that what is yield to maturity. What is yield to maturity? YTM. What is yield to maturity? Now, before moving ahead, we need to understand that what is zero coupon bond and perpetuity. Perpetuity and non-zero coupon bond. In the previous lecture, we covered whatever the questions we covered, that all these questions were related to the non-zero coupon bond. I mean, we have coupon bonds in any kind of a shape, but in today we will understand that what is zero coupon bond and the perpetuity. In zero coupon bond, as name suggests, that there would be no coupon rate, then how we will solve these questions. First, let's take an example and then I'll give you a formula. Example is that valuation of for the occasion bond is a version of the or of that used for a normal interest rate. For example, suppose a company issued a zero coupon bond having a 10-year maturity and $1,000 face value. How much face value we have? Now we are going to solve zero coupon bond case. Face value we have 1,000 and maturity, that is N, which is 10 years, and they said that it has a required rate of return K is 12%. Now the formula would remain same for all of these things, but the initial part, like for example, we have the formula of the bonds valuation I 1 minus 1 plus K minus N K plus MB divided by 1 plus K power N. Now, because we have zero coupon, so everything would be when everything will multiply by with that amount, so that would become 0. So we just have a formula MV 1 plus K power N. What do you need to do? You just need to add the value. Maturity value we have 1,000 and K we have 12%, so 1.12 power 10, and we will get is 322. Okay, so if you could purchase this bond for 322 and redeem it 10 years later for 1,000, your initial investment would be provided with 12% compound annual rate of return. Okay, this is the indication of the V. If we talk about the perpetuity case, the perpetuity, as we already have a discussions, that where there is no time given, where there is no time is given, we normally said that this is a perpetuity. You can say where n, like number of years, are missing, and you don't have any kind of information, regarding their number of years. That's become infinite time period. Infinite time period. So in that case, how you would calculate the value of the bond? So formula would remain same. Not formula would remain. Formula would be changed. V is equal to I mean coupon rate and your required rate of return. Okay. For example, let's take an example from your book. Example is that suppose that you could buy a bond that paid a $50 a year forever. That would buy a bond paid $50 a year forever, assuming that now you have a that paid, so that paying, so that's mean we have a coupon payment that $50 and a year forever, assuming that required rate of return, so K we have let's say 12%. Then what would be the uh, present value of this security would be? So just put it into the formula. V is equal to 50 and 0.12. So how much we will get? We will get 416.67. That means this is the maximum amount that you would be willing to pay for this bond. If the market price is greater than this amount, however, you would not want to buy that bond. Now, we were discussing about the yield to maturity. What is yield to maturity? We normally said this is YTM. YTM. It is a total return anticipated on a bond. Total return anticipated on a bond. If the bond is held until its maturity, YTM is considered a long-term bond yield but expressed as an annual rate. Why it is important? It helps the investor to make a comparison and choose the best investment options. Okay, so the formula of YTM is very simple. We have face value minus current value divided by N, and you have to add coupon, and then I divided by face value plus current price divided by 2. Let's take an example and solve this question. For example, a company that is offering face value, bonds face value, which is 1,000, and its current selling price is 820. It's selling on a discount, okay? And for 8 years with a coupon rate 8%, sorry, with a coupon rate, let's say 9%. We just have to calculate. Now, coupon rate, if you wanted to calculate the coupon payment, 10,000 multiplied by 9%, and we will get 190. So we will get 90. Now, 90 plus, we have face value, which is 1,000 minus, just put that values into the formula. Okay, then face value, which is 1,000 plus 820 divided by 2. YTM. Okay, and how much we will get at the end is 112.5 and 910, and ultimately you would get 0.1236, and when you will multiply by with 100, then you would get 12%. Okay, now how you will explain this thing? if YTM is greater than your I, mean coupon rate, coupon payment, that's mean it's selling on a discount. Selling on discount. In any case, YTM is lesser than I, then it's selling on premium. Now, in this example, if you would see, the coupon rate were 9% and the YTM is 12%. So that's mean it's selling on a discount. So if we have that condition where YTM is lower than I, so you would say that it is important or it is better for the investor who wanted to take the risk, who wanted to take a free risk. Some people who don't want to take risk, they want a free trading. So if YTM is lower than their coupon rate, mean no risk and lesser risk and lesser return, it would be good for the investor, for that particular group of people who don't want to take a risk. But if that condition, this is where the YTM is a higher than coupon rate, that means there is a high risk. Okay, so that is for those people who wanted to accept the degree of the risk, because if there would be a degree of a risk, high degree of the risk, then that there would be higher return. Okay, so that is the difference of these YTM and the combination or the different conditions when we will make a comparison with the I.